The 1990s began with uncertainty after the turbulence of the late 1980s, including the 1987 stock market crash and high inflation battles. Global markets needed stability. The decade opened with a recession, but it would soon transform into one of the most profitable eras in modern investing. The stage was set for innovation, rapid globalization, and the birth of a new digital economy. Throughout the 1990s, governments around the world embraced deregulation. Banks, investment firms, and corporations gained more freedom to innovate. This opened doors to new investment strategies, new asset classes, and the rapid expansion of global capital flow. The rules changed, and so did the risks. Inflation fell dramatically in the early 1990s, especially in Western economies. This created predictable financial environments where investors could take long-term positions. With stable prices, interest rates gradually dropped, making borrowing cheaper and investing more attractive. Before the dot-com bubble, the digital revolution of the 1990s was already reshaping investment behavior. Personal computers entered homes, the internet became mainstream, and data flowed faster than ever. Investors gained unprecedented access to research, company reports, and real-time market updates, fueling new strategies. Trade barriers fell, foreign markets opened, and developing nations embraced capitalism. Companies expanded internationally, and investors diversified across regions. Globalization created new opportunities but also introduced new types of volatility. A major shift came when retirement systems moved from pensions to self-directed 401k plans. Suddenly, millions of everyday people became active investors. Mutual funds exploded in popularity, fueling a boom in equity markets. With interest rates falling throughout the decade, borrowing became cheaper. Corporations invested aggressively, consumers spent more, and stock valuations soared. The conditions were ideal for explosive growth in equities, and investors took advantage. Channels like CNBC and Bloomberg transformed investing. For the first time, real-time financial news was broadcast 24/7. Investors had immediate access to market insights, fueling rapid decision-making and giving rise to more active trading styles. As internet companies multiplied, investor excitement grew. Even before the late 90s bubble, early tech firms attracted unprecedented enthusiasm. Many investors adopted aggressive strategies to capture the growth of digital businesses. By the mid-1990s, optimism dominated global markets. The fear from previous decades faded. Instead, investors believed technology, globalization, and innovation would deliver endless growth. This psychological shift played a major role in shaping the top investment strategies of the decade. In a decade full of rapid innovation and unpredictable market movements, blue-chip companies represented stability. These were the giants Coca-Cola, IBM, General Electric, Johnson & Johnson, businesses with long histories, global footprints, and trusted brands. Investors in the 1990s valued their reliability, consistent earnings, and resistance to economic shocks. A major advantage of blue-chip stocks during the 1990s was dependable dividend growth. Many established firms increased dividends year after year, making them ideal for long-term wealth building. Investors reinvesting dividends saw exponential growth as markets rose. Blue-chip companies were favored by big institutional investors. Pension funds, insurance companies, and mutual funds poured billions into these firms. Their presence provided stability in price movements and increased liquidity, making blue chips safer for retail investors. Though the 1990s were largely bullish, moments of volatility still appeared. During dips, blue chips acted as defensive assets. Their diversified operations and reliable earnings insulated them from sharper losses suffered by smaller firms and new startups. The 1990s saw multinational expansion at a scale never witnessed before. Blue chip companies entered emerging markets, creating new revenue streams in Asia, Latin America, and Eastern Europe. Investors recognized this global footprint as a key advantage. Unlike tech startups or speculative ventures, blue-chip companies managed risk carefully. With strong balance sheets and access to cheap credit, they maintained strategic stability. Investors seeking long-term security prioritized them over more volatile sectors. In the 1990s, long-term investing became more mainstream thanks to the growth of retirement plans. Compounding returns from blue chips, especially dividend-paying ones, became a wealth-building engine. Investors learned that time in the market mattered more than timing the market. The 1990s were a golden era for brand loyalty. Blue-chip products filled households worldwide: Pepsi, Microsoft, Sony, McDonald's. Investors understood that global brand power meant consistent revenues, giving these companies an edge over competitors. Financial advisors often recommended building a portfolio around blue-chip stocks. They formed the foundation, the core, while other investments, such as tech or international stocks, served as the satellite. This core satellite strategy gained worldwide popularity. By the end of the decade, many blue-chip stocks had doubled or even tripled in value. Their performance proved that slow, steady, and disciplined investing could generate remarkable results. The success of blue chips became a lesson in fast-changing markets. Stability still wins. The 1990s ignited a transformation unlike any era before. Computers left the confines of labs and corporate offices and entered living rooms, classrooms, and small businesses. The rapid digitalization of everyday life sparked investor interest in companies driving this technological revolution. Growth stocks, especially tech innovators, became the new frontier for wealth creation. Before the decade began, the internet was a niche tool used by governments and universities. But by the mid-1990s, it evolved into a global information highway. Investors recognized that the internet wasn't just technology, it was the future of communication, business, and entertainment. Every new internet-based company attracted immense attention. Silicon Valley transformed from a technical region into a global powerhouse of innovation. Startups multiplied. Venture capital firms poured billions into software, hardware, and internet services. Young entrepreneurs became icons of modern wealth, and investors sought positions in every promising tech venture. PC makers like Dell, IBM, Compaq, Apple, and Gateway saw skyrocketing demand. Households and businesses upgraded rapidly. Each new version of a computer, chip, or operating system meant faster processing and higher stock valuations. Investors saw these companies as engines of growth and pushed prices higher. The software shifted from a niche industry to the beating heart of the economy. Microsoft dominated operating systems, while companies like Adobe, Oracle, and Intuit built products essential to everyday work. Their recurring revenue models and high profit margins made them irresistible to growth-focused investors. Companies like Amazon and eBay introduced a concept that seemed radical at first: buying products online. Investors quickly saw the potential. E-commerce represented unlimited scalability, and early adopters captured massive public attention. These companies laid the foundation of the modern digital economy. While blue chips offered stability, growth tech stocks offered speed. High earnings potential overshadowed traditional valuation models. Investors bought future potential rather than present profits. Fast-growing companies doubled or even tripled in value within short periods, encouraging more aggressive investment behavior. The 1990s saw venture capital funding reach levels never witnessed before. Investors hunted for the next technology giant. A simple business plan or even an idea could attract millions in funding. This aggressive capital flow accelerated innovation but also inflated expectations beyond realistic limits. By the late 90s, the excitement turned into a full-blown mania. Companies with doublequotes.com in their names instantly gained value. Some had no real product, no revenue, and no customers, yet investors flooded them with money. The belief was simple: the internet would change everything, so any internet company must be a golden opportunity. Tech investing in the 1990s created fortunes but also introduced unprecedented risk. While many companies became global giants, others collapsed completely. The lesson from the decade was clear: growth investing could yield extraordinary returns if supported by real innovation, strong leadership, and sustainable business models. The 1990s marked the first time in history that average investors could easily place money outside their home country. Falling trade barriers, expanding global banking networks, and new international mutual funds turned the world into a giant opportunity map. Investors realized that economic growth was no longer limited to developed nations. Emerging markets were rising fast. Countries like Brazil, India, China, Mexico, and South Korea saw rapid economic expansion. Their young workforces, growing cities, and increasing manufacturing capabilities fueled investor excitement. The term emerging markets became a powerful buzzword, promising higher returns compared to mature Western economies. Global trade agreements, such as NAFTA and WTO expansions, opened international borders. Countries embraced capitalism and foreign investment at unprecedented levels. As goods and services flowed across continents, capital followed, making global diversification a mainstream strategy for the first time. Previously, investing abroad was limited to the wealthy. But in the 1990s, international mutual funds gave everyday investors access to global markets. These fund managers specialized in identifying strong overseas opportunities, giving diversified exposure to multiple countries and industries. Asian economies led the global growth race. Japan, South Korea, Singapore, Malaysia, and China expanded rapidly. Investors poured money into Asian stocks, infrastructure, and export-driven industries. This became one of the most profitable global investment themes of the decade. Latin America faced economic turbulence in the 1980s, but the 1990s brought reform. Privatization programs, foreign investment incentives, and stabilized currencies attracted investors seeking high-growth opportunities. While volatile, the region became a major destination for risk-tolerant capital. The creation of the European Union and the introduction of the euro unified Europe's financial landscape. This reduced currency risk and encouraged cross-border investment. Investors saw Europe as a more stable and interconnected market, increasing its global appeal. By investing across different regions, investors reduced their exposure to any single country's economic cycle. If the US market dipped, Asian or European markets could balance the portfolio. This concept, once advanced, became one of the foundational principles of 1990s investment strategy. Investing globally also introduced currency fluctuations. A rising foreign currency increased profits for investors, while depreciation could erase gains. In the 1990s, currency movements created opportunities for traders and risks for long-term investors. Learning to navigate exchange rates became essential. By the decade's end, global diversification was no longer optional, it was expected. Investors recognized that opportunities existed everywhere, not just in their home markets. This shift reshaped portfolio construction for decades to come and laid the foundation for modern global investment strategies. The 1990s saw the mainstream adoption of advanced risk metrics like value at risk, downside deviation, and stress testing. Investors became increasingly quantitative, and risk measurement evolved from a side activity into a core part of financial strategy. For the first time, firms could model worst-case losses with mathematical precision. Behavioral finance began gaining traction in the 1990s, revealing that markets were far from rational. Research highlighted how emotions, biases, and herd behavior influenced investment decisions. The decade marked the beginning of understanding investor behavior scientifically. Overconfidence was a driving psychological force of the 1990s bull market. Investors believed in limitless growth and underestimated risk. This mindset contributed significantly to inflated valuations, especially in tech companies that had yet to achieve profits. Derivatives exploded in popularity as tools for risk reduction. Options, swaps, and futures became standard instruments for managing interest rate, currency, and market risks. While powerful, their misuse highlighted the dangers of complexity. Hedge funds aggressively expanded in the 1990s, employing leverage and innovative strategies to pursue outsized returns. While some succeeded spectacularly, others, like long-term capital management, demonstrated the fragility of extreme risk-taking. The 1997 Asian financial crisis exposed weaknesses in global risk perception. Seemingly stable economies collapsed rapidly, reminding investors that interconnected markets could transmit instability faster than ever before. As crises struck various regions and sectors, the value of diversification became undeniable. Investors who spread capital across global markets, asset classes, and industries experienced far more stability. This reinforced diversification as a core investment principle. The 1990s saw millions of retail investors entering the market for the first time. With easy access to information and brokerage accounts, public participation surged, but many underestimated risk, driven by optimism and lack of experience. Speculative behavior became a signature of 1990s investing. The belief that prices will always rise propelled risky bets, especially in tech stocks. Speculation was both a wealth generator and a warning sign of looming instability. By the end of the decade, seasoned investors sensed that volatility was rising. They strengthened risk controls, hedged portfolios, and became more cautious. These defensive actions showcased the evolution of risk awareness during the 1990s. By the late 1990s, index funds had proven themselves reliable, low-cost, and superior to many active managers. Their long-term performance inspired a shift in investor behavior. Today, indexing dominates retirement accounts, ETFs, and institutional portfolios across the world. ETFs were in their infancy during the 1990s, but their structure, low cost, instant diversification, and real-time trading planted seeds for a massive future boom. Today, ETFs manage trillions and serve as the backbone of passive investing worldwide. The 1990s globalized finance. Markets became synchronized as technology, policy changes, and capital mobility accelerated. Today, investors cannot ignore global trends. A shock in one nation often cascades across continents within minutes. What started as speculative excitement in the 1990s evolved into long-term dominance. Apple, Microsoft, Amazon, and other early innovators eventually became the backbone of global indices. The decade permanently established tech as a critical investment category. The 1990s introduced millions of everyday people to direct stock trading. Online brokerages opened the floodgates. That culture persists today. From mobile apps to commission-free trading, retail investors remain a powerful market force. The quantitative foundations laid in the 1990s accelerated during the next decades. Algorithms now execute orders, evaluate risk, and manage portfolios faster than any human. Modern finance runs on models, data, and automated decision-making, all built on 1990s innovations. Derivatives, once niche, became essential hedging tools after the 1990s. While abuses of leverage caused crises, derivatives improved risk management, protected global firms, and stabilized markets when used responsibly. The psychological insights of the 1990s now influenced advisors, economists, and investors worldwide. Concepts like loss aversion, herd behavior, risk tolerance, and emotional investing are staples of modern financial planning. The lessons of the 1990s, especially during volatility and crises, solidified diversification as a timeless strategy. Modern portfolios balance stocks, bonds, commodities, and global assets to reduce risk and improve resilience. From passive investing to global integration, from behavioral insights to technology-driven analysis, the 1990s shaped today's financial environment. The decade's strategies remain powerful guides for wealth creation, risk management, and long-term investing in the modern world.